The decline in labor share of profits was generally, oscillating fairly constant for a long number of decades, and right around the change of the turn of the century, began to drop precipitously, and continued to do so for more than a decade. It's very troubling. We want an economy that works for everyone, and that happened, by the way, in essentially all advanced economies, and probably a range of factors are responsible for that. In the last 5 years or so, labor share of profits has been sideways. This is very much akin to the flattening out of median incomes over the last few decades. So it's got to do with a number of global factors. The thing that we can do is to take seriously your congressional order that we seek maximum employment. So in tight labor markets, workers are more likely going to be paid well and paid their share. I would say most of the factors that have driven down labor share of profits are really not under the control of the Fed, and so those are issues that we don't have control over.
But would you say that the tax bill did not affect those downward trend in wages positively? That it has, in fact, it's done nothing to reverse what you've seen as a decade or more of decreases?
I think wages are set in the marketplace between workers and companies, and they're affected by a range of factors. I think it would be early to be looking for a bill that was signed into law less than a year ago to be able to visibly be affecting much of anything at this point. Really, these things, big changes in fiscal policy, take quite a while to affect wages.
So none of this good news we're talking about today as a result of this tax bill. It's too early.
It's very hard to isolate the effect. I mean, I'd say wages have moved up meaningfully over the last 5 years. It's been quite gradual, and we certainly think it would be fine for them to move up more.
Do you think the European Union is a foe of the United States?
No, I do not.
Thank you. As we look ahead to some of the potential obstacles, and having both of us lived through 2008 and 2009, where it looked good and then it looked real bad. In retrospect, we saw some signs of the danger. What are the signs of danger that you're sort of focusing on? There's huge deficits, both government deficits, private deficits worldwide. You've got a trade battle brewing, and you've got things like Brexit that could complicate our life dramatically. So what are the 2 or 3 things that you think could throw us off this track?
There's a difference between the longer term and the short term. So in the near term, things look good. We look very carefully at a range of financial conditions and financial stability vulnerabilities. We feel that those are at sort of normal, moderate levels right now, although there are some areas that are elevated. Some asset prices are high, and there's an elevated level of debt in the non-financial corporate sector. More broadly, banks are well capitalized. Households are in much better shape. So financial stability, I don't worry about too much at this point, although we keep our eye on that very carefully after our recent experience. You mentioned trade. It's hard to say what the outcome will be. Really, there's no precedent for this kind of broad trade discussions. In my adult life, I haven't seen where essentially all of our major trading partners. Hard to know how that comes out. If it results in lower tariffs for everyone, that would be a good thing for the economy. If it results in broader, higher tariffs across a broad range of traded goods and services that remain that way for a longer period of time, that'll be bad for our economy and for other economies too.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.